Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for April 10th, 2016. Market remains in bullish quiet. On an annual basis, using weekly RSI 14, we're in the middle range of neutral, 56 out of 100. Shorter term condition, we are in the low end of neutral at 44 out of 100 on the 10-day NDX. These are the symbols that we're holding in the various blended monthly rebalancing portfolios, with the next reevaluation due on or about 1 May. These are the current leaders in the clubhouse as of the close on Friday. ETF2 remains at 90% theoretical exposure, and the model portfolio is also at 90% exposed. In the market mosaic, price with respect to the 200-day moving average is green bullish at 2.52. The slope of the 50-day moving average is also green bullish, 0.85. ADX is a non-trending 17.8. Bulls slightly in charge. The risk index is the 30-period moving average of the VIX divided by the 10, and that comes in at 1.087, so we are in risk on mode. Take that score of 1.087 compared to the last 5,000 trading days. Find the average and the standard deviation, and computes the risk Z at 0.92. This histogram shows the last 90 days of that indicator. Seeing we've had rising lows, went from minus 2 sigma to minus 0.3 sigma. Now we've had a nice run of positive conditions, but that starting to change here as it has rolled over from slightly over 2 sigma, and now we're back at 0.92. This is a time of the season in which we are preserving profits, being very careful to measure our risk and reward, not overloading any one sector, watching our portfolio heat, still taking long signals, but recognizing that we've had a long run of declining volatility that is now starting to change as some cracks come into the market. We've had a nice run the last 30 days. This is a warning to make sure that we're paying even more attention than usual to our stops. These are the quick looks at the blended monthly rebalancing portfolios. I see Latin America and Treasuries, oddly enough, one of the volatile indexes, and the risk-free rate of return, both at the top. Only Japan is on a cash signal right now. Still a lot of weakness down here in the U.S. small caps, IWM, and then the global. So this is dominated by mostly the emerging markets and alternate asset classes right now, the top 4 being Latin America, Treasuries, real estate, and emerging markets, then the conservative Dow. So kind of an odd mix of extreme growth potential and very conservative posture. In the ETF 32, Brazil, Latin America, and utilities at the top. So you get, again, an odd juxtaposition of offense and defense. Only a couple symbols still below their 4-month moving average: agriculture, financials, and Japan. And in the ETF Max, some amazing performances here in the golds and the miners. Looking pretty awesome. I'm looking for more momentum in there. Brazil mid-cap, was down 6% the week, and so that may be a warning that it could be rolling over, or it's a chance to buy the most recent strength on sale. So we'll be watching that one closely for intraday trading of the whole Brazil complex. The German Bund and Russia on strength in energy. So some interesting choices to play the next step in momentum. Looking at the S&P 500, Newmont Mining and Wynn Resorts, Wynn being one of our favored day trading turbo candidates, moved up here to the top. Take a look at the Console Energy, Range Resources, Cabot Oil and Gas. So again, you can see the energy complex in full play here. Maybe some reverse momentum here in Urban Outfitters and Cores. Apache and Sherwin-Williams on the upside. So lots of choices in the momentum area to look at for next this week coming up. Now the market health check. See, the market has the river has come out of the from underneath the 200-day moving average, which is still sloping down. We're only a couple percent off from the swing high target, up around 208. The slope of the 30-period regression line has been a good tell for the market. You can see that we've had some sideways chop here in the last 15 days. It's held the mark here sideways, and that has caused this steep 30-day slope up to roll over back towards the zero line, and the zero line is hidden underneath this red support line. So it's still positive, and that's favorable, but you can see definitely the market has taken on a different characteristic as it looks like it's digesting this nice run up that it's had right here. So we're going to be careful to watch the support level here around 202. The 10-period and the 30-period regression lines are still up. It's got to get above 208 and hold to make this to make the case for another leg up. But if it does, and to be fair, it hasn't failed in the last 10 days. If it makes it above there, then I would expect that leg up to be as large as this leg, so another maybe 5% or about 10 points. That would take it to all-time new highs. So interesting stuff here. ETF2, 9 out of the 10 indexes are on buy signals, so that gets us, it keeps us at 90% invested, 10% cash. The U.S. at 41 is still better than the globals at 36. Inside the U.S., it's the mid caps, then the large caps, then S&P, then the mid caps, then the S&P, then tech, and then small caps. And the two weakest sectors appear still being Europe and U.S. small caps. Strength in utilities, farms, and technology. Finance still lagging here. And so is healthcare. So we're going to keep watching that. Almost all of the U.S. now back above average. Japan below average. Latin America and Brazil extremely strong. The rest of the emerging markets all looking above average. A mixed bag in Asia. Vietnam very laggy, along with India and Hong Kong lagging, but everything else above average, with Indonesia and Malaysia still strong. It's about the 5th week in a row for that. Everything Europe underwater. Top 30 in the ETF2 mirrors really the same things that we saw in the blended monthly. So you see Brazil and Latin America, the gold mining complex, XME, remains very strong as a way to play a broad-based approach to the metals. Russia on the strength of the energy sector. Declining strength down here, though, in the basic commodities of gold. And then weakness here in the consumer staples. So this makes me cautious about this the strength in the gold miners. When the underlying metal starts rolling over, I'm concerned about those being too far advanced, and there may be some short side opportunities there once they collapse. In the Dow 30, only 3 symbols in the red: Goldman, American Express, and Disney. That's 2 of the 3 being part of that financial sector weakness. You see Morgan down here as well, and Visa. In the upper half, it still remains Verizon, 3M, Chevron, and McDonald's doing good. Caterpillar is reemerging as a strong force here with the green and the white. A little bit of weakness coming into Procter & Gamble, ExxonMobil, and General Electric. So we have some choices among the large caps. Flash over to the daily real quick. A bundle of decent setups across the swing trade spectrum here in the large caps. Plenty in the auto framer to choose from. Some 551 set up across the board here in the indexes. You can see this long run of volatility that has declined and got us into the quiet and started to curl back up. So this is a posture where sharp volatility events can occur, and I combine that along with this view of the risk index up here, and I'm concerned about quick sell-offs as a way to test the resiliency of the market. Handful of channelings and triple screens and 551Ws, 5 or so on the auto framer that trigger. Lots of good frog candidates. And only Goldman Sachs triggers on the RSI 2. Some good 551 candidates in the indexes, along with half a dozen auto framers. Only a couple frog quality numbers, but here's a 4.0 in blended commodities, and then 3.2 in the materials. Good candidates to choose from here in the auto framer. I'll be looking at Disney, Latin America, emerging markets, and Verizon. These in the green top shelf are the ones that are the most ATRs below their own RL270. These are the deep value plays. The ones in the red on the bottom shelf are the ones that are maybe overheated or are at least relative strength leaders going forward. So you can see 3M, for example, almost 8 ATR above its own RL270, so it's moved down quite a bit. These are the daily squeezes set up for one-day swing trading, 1 day at a time, for one-day large pops relative to the risk, the range risk that they have from Friday. I'll be looking at Walmart, real estate, Devon Energy off of that list. See the volatility starting to flatten out. It's rolled over here on the long-term chart. You see it's crossed its 10-period moving average back here, and it's been really sideways for the last 10. The polynomial regression has crossed back over the 10, kind of making it official that it's rolling over. And you can see that as far as price relative to the 200-day moving average, this is as high as it could get the last time it came out of that deep sell-off channel, and then it couldn't really make any more gains in here, and then sold off sharply again. So that's obviously the move that I'm concerned about. Would like to see it hold above the 200 and then start to make a move. Now the 200-day moving average, as we saw, is starting to decline. It was actually rising back in here. So the market itself has rolled over. So now there may be a chance for this to actually find support and start up the next leg. So we'll see. Background information on statistics for those of you keeping score at home. You can see the long-term performance over the last 40 days, exceptional across the board, but now you've got this last 5 days really has been a period of underperformance as it digested all of those long gains. That's sort of a natural and a market-wide phenomenon. Markets come back to the edge of the river now. That's actually a healthy thing, but we'll see what it can do from here. The last time it did this, again, we had this sideways choppy period, another sideways channeling kind of a deal, and I'm concerned. So it really has to hold above 195. I see this now as the new critical support. I'd really like to see the southern edge of the river hold at about 198, and we'll see what comes out of this. The 90 has come back to its to the middle of its z-score for its regression line slope. The 10 has declined steadily back to the midpoint. The 30 has rolled over. So again, this is the pause that refreshes. And what are we going to get? An upward move, a sideways move, or a downward move? That's quite different than this last 30 days regime. So we are well aware of that change in condition. So some more stats. And that's everything that I wanted to cover from this weekend's report. Keep your risk measured and your powder dry. When we are at a critical zone like this, that's an ideal time for the shorter term traders to be able to frame those low risk trades intraday and use that to build towards momentum moves that turn into swing trades. So we'll be shortening up our time frames accordingly, which is timely as we have just started the online day trading workshop, a 10-week course designed to really go deeper into the various techniques that we've been developing in the chat room. And exciting first week so far, and we look to continue to learn even more as we go. So, Ken Long from Tortoise Capital, keep your risk measured and your powder dry.